I just saw Malcolm Gladwell speak to hundreds of fools. Where were you? Investor Beat starts now. Thanks for watching. I'm Alison Southwick. The market is up today ahead of tomorrow's jobs report. Many are eagerly waiting to see if December's weak employment figures were just a fluke, so stay tuned. Joining me in studio is Jason Moser. So we're going to get to our top story here. Green Mountain Coffee had a banner day, up nearly 30% after announcing a 10-year partnership with Coca-Cola in an effort to ruin SodaStream's day. I'm being vague about what the deal is because, as it turns out, we don't really know what the product is.
Yeah, you're right. I mean, we don't know a whole heck of a lot other than Coca-Cola saw fit to invest about $1.2 billion into this market. And so I think really, first and foremost, what that does is validate this market, right? From the very beginning, we were kind of wondering about the market opportunity for SodaStream here in the United States. SodaStream has done very well internationally speaking, but the United States was always really the story. Coca-Cola's investment in Green Mountain Coffee, that validates that this is a genuine market opportunity. They see it and they're investing big bucks in it. And ironically, I think it was kind of nutty to watch the release yesterday because after hours, SodaStream was down up to 10% after hours trading. Today, it's having a great day. And I think it's having a great day because the market is kind of looking past this big relationship with Coca-Cola and saying, wait a minute, this is a genuine opportunity. It doesn't necessarily have to be a zero-sum game. And who knows, maybe SodaStream comes out with a relationship with Pepsi or something here in the near future as well. It's certainly a lot of questions still to be answered, but it's definitely interesting to watch. Right,
so if you had to invest in one, talking about, you got Coke, you got Green Mountain Coffee Roasters, or SodaStream. I know, it's a tough one. It's a tough one. We got three big players here. How would you play this?
Well, so Coca-Cola for me is probably a little bit too big and a little bit too boring for me. I'm looking for something that's going to be a little bit more wealth growing, I think. I would probably opt for Green Mountain, though, and I think the reason why is because, number one, first and foremost, Green Mountain is coffee. They've been very successful with that model, and those Keurig machines are everywhere. So I think that they're going to continue to realize a lot of success with coffee. I don't think soda is as powerful as coffee. I think people are more passionate about their coffee than their soda. But Green Mountain Coffee, at the end of the day, is becoming more things. It's not just soda. Now it's going to be coffee, possibly soda. They're trying to introduce soup into this thing as well. So they're looking at a lot of different plays here, and I think they probably are recognizing a little bit of a bigger market opportunity at this point. So.
All right, well, let's move on to some of the day's movers and shakers. Twitter plummeted this morning following their earnings release, even though they beat top and bottom line expectations. The problem, they only added 9 million new users. This just doesn't seem fair.
No, it's not, is it? Well, I mean, I think we could probably also say it didn't seem fair that the stock climbed up to $70 here recently, because that certainly was a lofty and very optimistic valuation. So really, the way I look at this, and this is coming from the perspective of a Twitter shareholder and a bull on Twitter generally speaking, this is a great pullback. We were hoping this was going to happen because when you look at the way the quarter came out, it was a good quarter. They're growing that user base. There were some enhancements to the timeline products that they have that appeared to bring back maybe a little bit on the engagement side, but actually interactions were up quite significantly. So messaging, retweets, favorites, all those kinds of things actually indicated a lot more activity. So that's encouraging as well. This is still a very early story here, and I think Twitter's kind of learning about this market opportunity in mobile advertising. And let's not forget that really this is going to be about a $45 billion market in mobile advertising here by around 2017. So it's not, again, a Twitter wins, Facebook loses, Facebook wins, Twitter loses. You're seeing Twitter, Facebook, and Google really all help define this space, and I like this pullback a lot. I think it gets Twitter stock on a lot of radars.
All right, so maybe a buy opportunity, you think?
Could be.
Maybe.
I'm looking at it that way for sure.
Yeah. Dunkin' Donuts delivered a great big heart-shaped donut to investors, announcing that fourth quarter earnings rose 23%. They also upped their dividend. Now, for our viewers out there who are on the West Coast side of the country, they do not have the same appreciation or passion for Dunkin' Donuts like they do here in the East Coast, but that's changing.
Yeah, it is changing, and you're right. I think Northeast has really just some tremendous fans where Dunkin' Donuts is concerned, and that's one of the things I like about this company. It does have a brand that elicits a lot of customer loyalty, and so when you see this company bringing in double-digit top-line growth and 3.5% comps in really what has been a very difficult quarter for restaurants in general, that's encouraging. But what really takes me over the top on Dunkin' here, and I said it last week on Motley Fool Money, this new rewards program that they're introducing, it's called DD Perks. And it's essentially like a Starbucks reward program. It's just for Dunkin' Donuts. They're setting it up with an app. There's going to be mobile payments involved. This is going to bring a lot of people into that Dunkin' Donuts ecosystem, so to speak. It's very sticky, very recurring, very powerful model here, where a lot of people are going to start giving Dunkin' Donuts money up front for the promise of donuts and coffee at a later date. I think this is a great move, and it's going to be a tremendous driver here over the next few years for Dunkin' Donuts.
All right, don't tell Chris Hill, but I still don't like their coffee. Pandora had its most profitable quarter since going public, but it still took a beating after reporting fourth quarter earnings. Why? Well, the guidance for next quarter isn't as rosy. With Spotify, Google, and Apple all moving in on their territory, what's Pandora's best tactic? I mean, are they on it?
I don't really find anything attractive about this market at all. Part of it is because music is just such a difficult industry in which to monetize. There are a lot of parties in there trying to get a hold of a lot of these. It seems the legalities are all very obscure. And I mean, when Pandora bought some little radio station in South Dakota or something in order to be able to pay out a certain royalty model there, it shows me that there are plenty of things in this industry that are out of their control. So I think it's a neat product. I don't know that I would ever pay for it. They make 90% of their money from advertising, and so if I'm looking at an ad place, Pandora's not going to be the first one I look at. And then, you really keyed in on, I think my primary concern here is the competition out there. As someone who has, integrated Apple Radio, iTunes Radio into my, daily routine, I mean, my kids like it, I like it. It's the same basic thing, and again, I'm not paying for it. So yeah, I don't like that Pandora's so levered to advertising, and I would be very careful about investing in it.
All right, that's going to do it for today's Movers and Shakers. I would like you to tell me one stock on your radar.
Well, are you a gamer?
No.
Neither am I. But there is a company here we follow, Activision Blizzard, and I think a lot of people out there know it. There are a lot of gamers out there. And Activision Blizzard is very interesting because they have really led the way to digital distribution in this gaming environment. You're seeing, GameStop, for example, the physical store is really suffering because everybody's getting their content digitally speaking nowadays. And Activision Blizzard has played a very big role in that, but they have never really gotten a lot of credit for all of the cash that they generate. And I think a lot of that is because they're so levered to two big games in World of Warcraft and Call of Duty. Call of Duty is still doing okay. World of Warcraft continues to bleed subscribers. So really, we want to see what their plan is, what new products are out there. They're doing okay with the Skylanders product, but Activision's just been such a stagnant stock. It's not the one I'm most enthusiastic about, but I'll look for the earnings and see what's going on.
All right. Well, for Jason Moser, I'm Alison Southwick. Thanks for watching.